Okay, so you've probably noticed it lately, haven't you?
Hmm.
Those long-term bond yields, like the 10-year Treasury yield.
Oh, yeah, they've definitely been climbing. You see the charts.
Right, and you look at that and think, well, what does that mean? Is it, inflation making some big comeback?
Or maybe it's all the talk about government debt. That's usually the go-to explanation, isn't it?
Yeah, you hear those takes everywhere.
Yeah.
But the source material we're digging into today, it offers a slightly different perspective.
Right. It sort of challenges those common narratives.
Yeah,
Says maybe we're focusing on the wrong things.
exactly. Welcome, everyone, to the deep dive. This is where we take your source material, articles, research, whatever you've got, and we really unpack it.
We try to pull out the crucial insights, give you that shortcut to really understanding what's going on.
And today, yeah, we're diving into this fascinating analysis of the global bond market, trying to cut through some of that noise.
Because here's the really puzzling part when you look closer. While those long-term yields, like the 10-year, are moving up, the short end of the curve, specifically the 2-year yield, it's been, well, remarkably steady. Anchored, almost.
Really, just holding flat while the long end rises.
Pretty much. And it's not just a U.S. thing either. Our source points out you see similar patterns in Canada, in Germany.
Huh. But their whole government budget situation is pretty different from the U.S., right?
Very different. Which suggests this isn't just about deficits, that disconnect, between the long and short ends. It hints that the standard explanations aren't telling the whole story.
Okay, so that's the mystery we're tackling today. Our mission really is to break down this source's argument in simple terms.
Get into what it means by waffles and twos.
Yeah, waffles and twos. We'll explain that and show you why this particular analysis might offer a much clearer signal from the bond market than you'd get otherwise. Let's get into it.
Okay, so first off, the source really takes aim at those common myths we just mentioned.
The deficit panic and the inflation freakout.
Exactly. It argues that the idea that rising long-term yields are purely because the market's suddenly rejecting government debt, or it's just a simple knee-jerk reaction to inflation fears. Well, the source says that explanation gets trotted out a lot, but historically,
It doesn't usually hold up.
it rarely proves to be the main driver, according to this analysis. You hear it often, but the evidence isn't always there.
I feel like I hear that deficits cause high rates argument constantly, so the source is saying, maybe not so much this time.
Or perhaps ever as the sole, primary reason in situations like this. Its analysis suggests that narrative gets a lot of airtime, but it might not be the fundamental force moving long yields in this specific way.
And the point about Canada and Germany really drives that home,
Right, because their yields are also under upward pressure, the long-term ones anyway.
despite very different debt levels and fiscal paths compared to the U.S.
Correct, which points towards something more global, or at least not just about U.S.-specific deficit concerns. There's some other driver at play.
Okay, so if it's not just deficits, not just a straightforward inflation panic pushing up the 10-year, what is it then?
This is where our source brings in those two key elements, waffles and the twos.
Right, waffles and twos. Let's start with waffles. Sounds tasty, but probably not literal.
Yeah, no, not literal waffles. The source uses it as a metaphor for the behavior of central banks,
Oh.
particularly the Fed, the Federal Reserve.
Okay. Waffling, like
Yeah,
indecision,
Yeah.
flip-flopping.
exactly that. Indecision, uncertainty. Picture the Fed standing in front of two doors.
Okay.
One door says, cut rates, the economy looks weak. The other says, hold tight, maybe even hike, because we're still worried about inflation.
And they're just stuck between them.
Kind of shifting their weight, looking back and forth, not really committing to either door. That's the waffling. It creates this unnecessary uncertainty in the market about what they'll do with short-term rates. When will they cut? Will they cut?
And the source connects this waffling to something deeper, like a historical pattern.
Yes. It traces it back to what it calls the central bank's long-standing institutional bias toward inflation.
A bias towards inflation. Or against it.
Sorry, a bias towards fighting inflation. Seeing inflation risk even when maybe it's not the biggest threat.
Ah, okay. Like they're always looking for reasons not to cut rates.
That's the argument. The source suggests this bias is deeply ingrained, goes back decades. It mentions figures like Arthur Burns back in the 70s, but also more recent examples,
Like when?
like the Fed seeing inflation risks in the mid-90s or early 2000s that didn't really pan out. Or even, debating rate hikes in 2008 because of high oil prices, right before the whole financial system nearly collapsed.
Wow, okay. So they have this historical tendency to maybe overemphasize inflation risks.
According to this source, yes. It means they're often hesitant to fully acknowledge economic weakness or commit to cutting rates, even when some data starts pointing that way.
So when we get, say, a slightly higher inflation number from the UK, or maybe Canada's core CPI ticks up,
Or even just talk about tariffs possibly being inflationary.
right, that feeds right into this bias, makes the Fed even more hesitant, more waffly.
Exactly. It reinforces their caution, increases the uncertainty about rate cuts, even if other signals, maybe weaker jobs numbers or consumer spending, suggest the economy is softening. Gives them more reasons to kind of wait and see.
Okay, that covers the waffles. Now, what about the twos? That's the two-year bond yield, right?
Correct. And normally you think of the two-year yield as being the most sensitive part of the bond market to what the Fed is expected to do in the near term.
Right. So if the Fed is waffling and creating all this uncertainty about its next moves, shouldn't the two-year yield be jumping all over the place? Why is it stable?
This is the really crucial point the source makes about the current market environment. It calls it a bull steepening.
Bull steepening. Okay, what's that mean simply?
It just means long-term yields, like the 10-year, are rising faster than short-term yields, like the 2-year. The gap between them is widening, with the long end going up more. And the source argues that in these specific conditions, the usual roles kind of flip.
Hmm.
Think of the whole yield curve like a complex weather forecast.
Okay, I like analogies. Lay it on me.
So in this specific weather pattern, this bull steepening, the 2-year yield, it becomes like the reliable short-term forecast.
Short-term weather forecast. Okay.
Yeah, it's anchored by the stuff you can see right now, the undeniable current economic conditions, the fundamentals on the ground.
While the 10-year yield.
Yeah, that becomes more like the long-range forecast, much more susceptible to unpredictable things, to uncertainty, like the central bank acting like a chaotic weather machine with all its waffling.
Okay, the Fed as a chaotic weather machine. I get it. So the two-year reflects the actual economic climate right now,
The fundamentals, yeah.
while the 10-year is reacting more to the uncertainty and the Fed's indecision about the future climate.
You've got it. In this kind of setup, the market sees a clearer potential profit if weakness really hits and forces the Fed to cut rates eventually.
And that profit is clearer at the short end.
Often, yes. The payoff from rates being cut is arguably higher or more direct at the short end, like in the 2-year. So the market puts its bets on the underlying economy, its fundamental read into the 2-year.
And the uncertainty, the will they, won't they from the Fed.
That gets channeled somewhere else. It gets pushed out further along the curve, finding an outlet in the longer-term yields, like the 10-year. That's what pushes them higher. They become the pressure valve for the Fed's waffling uncertainty.
Okay, let me try to connect the dots then. Waffles and twos. The Fed's waffling, driven by its history, its bias, its reaction to maybe ambiguous data, creates uncertainty about future short rates.
Yep, that's the waffle part.
And in this specific market dynamic, this bull steepening, that uncertainty doesn't make the two-year jumpy. Instead, it flows into the 10-year, pushing it higher.
Exactly. The 10-year acts as the main outlet for uncertainty right now.
Meanwhile, the two-year, the twos, stays relatively calm, relatively anchored, because it's quietly pricing in the actual economic fundamentals. Signals that suggest weakness, even if the Fed isn't shouting about it yet.
Precisely. And the source actually highlights some of those specific fundamental signals it thinks the 2-year is picking up on. Signs of that underlying softness.
Like what? What are the fundamentals saying?
Well, things like downward revisions to payroll data. You know, the jobs numbers initially look okay, but then they get revised down, showing hiring was actually weaker.
Okay, that's important.
Yeah. And insights from surveys, like the BDM survey, which tracks small business hiring intentions, it showed the labor market kind of stalling out. Also, benchmark revisions that significantly marked down retail sales, suggesting consumers weren't spending as much as we thought.
Less consumer power.
Right. And add to that some recent weak earnings reports and guidance from big retailers, like Target was mentioned. Fewer shoppers, spending less money. These are the kinds of real-world fundamental signals the source believes the 2-year yield is reflecting.
Wow. Okay, so that paints a very different picture than just yields are up because inflation deficit.
It does. So why does this matter to you listening right now? Why take this deep dive into, waffles and twos?
Yeah, what's the takeaway?
Well, it shows that what you see in the bond market isn't always straightforward.
Yeah.
The headline number, the 10-year yield going up, might not mean what the simplest narrative suggests.
Understanding that this dynamic, the Fed's waffling, interacting with how the 2s and the 10s price things differently right now.
Right. Understanding how one part reflects fundamentals while the other reflects uncertainty gives you a much clearer, more nuanced signal about what the bond market is actually saying about the economy.
It really does highlight how central bank communication, or lack thereof, their actions,
Right.
even if they're trying to be cautious.
Can end up creating confusion.
Yeah.
It can obscure the underlying economic reality that parts of the market, like the 2-year, might still be trying to price in.
So here's maybe a final thought to chew on, a provocative question for you.
Mm-hmm.
If the 2-year yield, according to this analysis, is telling us about fundamental economic weakness,
While the 10-year yield is mostly reflecting uncertainty, driven partly by the Fed's waffling and maybe, as the source implies, some outdated inflation fears.
then what does that tell you about the reliability of those mainstream economic stories that only focus on the rising 10-year yield?
Yeah. What should you really be watching more closely? Where's the real signal?
That definitely gives you something to think about. This whole deep dive really shifts how you might look at those bond charts.
It absolutely does. It encourages you to look, beneath the surface, find where the signal about the actual economy might be hiding.
Well, we certainly hope this deep dive into the source material gives you a useful new lens for looking at market signals.
Hope it was helpful.
Yeah. And hey, if you found this valuable, please do us a favor, like it, share it with someone who might also find it interesting.
It helps others find the show.
Absolutely. And to keep up with more deep dives and insights like this, you can follow What Bitcoin Taught Me on all the usual places: Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn.
Lots of options there.
Yeah.
Until next time, keep digging deeper.
And keep questioning. Take care, everyone.